Hello and welcome to the Business Standard Morning Show. I'm Nazia Iqbal, and here's a look at the stories for the day.
What the world needs now is people who see flight a little bit differently. Because seeing a better connected world isn't far in the future. We're building it now. GE, building a world that works.
The 47th GST Council meeting, which almost coincided with the 5th anniversary of the rollout of the indirect tax regime, took a host of decisions which will affect everyone. And this month also marks the end of guaranteed compensation to states by the center for their losses. Our next report tells about the key outcomes of the meeting and its likely impact on the stakeholders.
The goods and services tax collection was above 1 trillion rupee mark for the 11th month running in May, offering a big reprieve to the central government, which is in a tight spot due to external and internal headwinds. Rolled out on 1st July 2017, GST had subsumed 17 central and state levies. States now have indirect tax autonomy on excise revenues, which come from fuel and liquor, and on stamp duties. And 5 years on, the GST regime is still evolving. The 47th GST Council meeting was held in Chandigarh, and it ended on Wednesday afternoon with Union Finance Minister Nirmala Sitharaman addressing the media. Giving a leg up to the unorganized sector, the Council agreed to waive mandatory registration for small online sellers. From 1st January 2023, online sellers with an annual turnover of 40 lakh rupees or 20 lakh rupees in case of small and select states will be exempt from mandatory registration under GST. The move is expected to benefit 120,000 small traders. Currently, small offline sellers are exempted from compulsory registration. While reports suggested that there could be a 28% GST levy on online gaming, casinos, and horse racing, treating them on par with gambling, the Council decided to further deliberate on the tax rate and the method of valuation of taxation on such services. On the rationalization of tax rates, the Council has not taken up the issue, and a ministerial panel has been given 3 months' time to submit its report. Let us now move on to the crucial subject of compensation to states. At the time of implementation of GST, the centre had decided to compensate the states for any loss of revenue from the new tax for 5 years. The period ends on 30th June. Several states, mostly ruled by the opposition, have been demanding extension of GST compensation, citing 2 years of pandemic. However, the GST Council did not take any call on it. The proposal will likely be taken up again in the next meeting.
Today's GST Council decision will have repercussions on the state governments on 3 aspects. One, it will have its impact on the overall, in the revenue projection that they're going to make for the next year. In that sense, the uncertainty in terms of what revenue that the state governments are going to have is certainly will have its repercussions on the expenditures as well. So the uncertainty on both revenues and the expenditures will certainly will have its impact on the overall fiscal position. And second, it might hamper the recovery process that is happening in many of the states. So that's again is going to have a negative impact on the overall GSDP growth. And the third is, it might lead to deterioration of quality of public expenditure at the state governments. In the absence of GST compensation, the states may be forced, especially some of the states which are going for the elections, they may be forced to shift the expenditure from the capital to the revenue side, so that it will have its repercussions on overall GSTB growth in those states.
Meanwhile, the Council has also accepted the recommendation by the group of ministers on correcting the inverted duty structure. For instance, LED lamps, ink, knives, blades, power-driven pumps, and dairy machinery will attract 18% GST, higher than the existing 12%. Further, the GST rate on solar water heaters and finished leather was hiked from 5% to 12%. The GST Council has proposed to withdraw tax exemptions for few items, along with rate changes for few others. Exemptions have also been removed on a variety of services, including hotels with a rent below 1,000 rupees a day, hospital room rents, excluding ICUs, above 5,000 rupees per day, and services provided by RBI, IRDAI, and SEBI. The Council also wants all post office services other than postcards and inland letters, book post and envelopes weighing less than 10 grams to be taxed. However, goods that are unpacked and unlabeled are still exempt from GST. The Council has also reduced GST on some goods and services. The Council gave relief to the transport sector as it slashed rates on transport by ropeways and renting of truck goods carriage where cost of fuel is included. On whether to bring movement of gold and precious stones under the e-way bill regime, the Council has allowed states to decide on the threshold above which e-way bill can be generated. The ministerial panel has recommended a threshold of 2 lakh rupees and above. The GST Council has also decided to set up a ministerial panel to address various concerns raised by the states on the GST Appellate Tribunal.
One is the MSME relief that is now there under the GST law. So to recap for the benefit of all of you, for small sellers who are under the composition scheme or below the 40 lakh threshold, as things stand, they cannot go online without giving up that composition status or that exemption status. But going forward, this disparity is addressed and the MSME sector will have the access to the powerful e-commerce platform going forward and the e-commerce industry. Second is the tax tribunal. It's 5 years. There is no appellate tribunal in place. Industry is worried because as we progress into the audits and assessments, there are orders that need to be appealed, but the forum is not yet constituted. There has been some legal challenges vis-a-vis the earlier construct, and the council seems to have deliberated certain suggestions and formed a group that's going to be focusing on this. And I expect in the next few months, we'll finally see the tribunal, which will enable appeals to be going in a timely manner. The third point that stood out well is an ask from industry to address an inverted duty structure. So if your product is a 12% rate product and your inputs are 18, there was always a refund provision. However, that refund provision was not available if your inputs was a service. So to address that anomaly, a decision has been taken to expand and allow refund for inverted duty, including on input services.
If indeed some states find their recovery from the pandemic hampered, it begs the question, will that bode well for the overall economy?
सब अच्छी दिख रही हैं यार, कौन सी खरीदूं? ये तो वही बात हुई, 4000 शेयर्स लिस्टेड है, कौन सा लूं? वो तो सबसे आसान है। तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा पर है 4000 स्टॉक्स की रिसर्च, टेक्निकल टूल्स और इन्वेस्टमेंट आइडियाज। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
Experts believe that one of the reasons for a good GST mop-up was the elevated inflation. Meanwhile, RBI has been criticized in some quarters for being behind the curve in taming inflation. Jayant R Verma, an external MPC member, was the lone voice in the panel who has been highlighting the need to keep the inflation in check for quite some time. He was against the central bank's accommodative stance. In a freewheeling chat with Business Standard's Manojit Saha, the IIM professor said that now the country will have to tolerate a modest amount of growth sacrifice as the RBI fights inflation. Let's listen in.
Mr. Verma, welcome to the show.
My pleasure.
In the MPC minutes that was out last week, you said RBI still needs to do a lot of catch up. The repo rate has been hiked by 90 bips since May. How much of a repo rate hike more you see in the current year in 2022?
You see, what I was highlighting is that inflation has been rising faster than the repo rate.
Right.
So yes, 90 basis points looks large, and it looks like very decisive action until you see that the realized inflation has shot up by much more than 100, and even the the projection for the entire financial year, which is forward-looking, even that has risen by 100 basis points. So that's why I said that in terms of inflation-adjusted policy rate, we have barely budged from April. Now either inflation needs to come down on its own, and if it does, obviously the real rate goes up without our having to do something. Or we will have to raise rates, or it might be a combination of the two, that as we raise rates, inflation comes down, and because inflation comes down, the real rate goes up, and then we end up in a more sustainable position. Right now, the real policy rate is quite strongly negative.
Right.
Not just based upon April-May numbers, but even based upon the entire 22-23 projected numbers. Our repo rate is negative real. And I do not think the situation today calls for negative real rates.
So when do you see the real rates becoming positive?
I really don't know. Because, part of this surge in inflation that has happened is due to the Ukraine situation and stuff like that, which is global in nature. It's got nothing to do with domestic macroeconomic policy. So if that global environment stabilizes, if crude prices come down, other prices come down, we did see a large correction in metal prices, right, from the peak. Now, if crude also corrects, and if some of the severe shortages that we are seeing in things like semiconductor chips and so on, if those ease, then one would expect to see a significant drop in. And of course, if we have a good monsoon and food prices come down, because that's another thing which has triggered this inflationary surge. If a good monsoon leads to a drop in food prices and so on, then we could get a correction in food prices as well. And all of that put together could bring inflation down. And if inflation comes down, the task of the MPC becomes a lot easier.
How much of a growth sacrifice you think is tolerable in the current situation?
Well, you see, I think the situation now is very different from what it was, let's say in 2020 or early 2021. At that time, the pandemic was wreaking havoc on the economy, and it was absolutely unacceptable to worry about anything other than recovery, right? Today, I think the situation is different. The economic recovery is quite robust. Of course, we would always like faster growth, but the economy is doing reasonably well. And we are also at a point where I think inflation itself is posing a threat to the recovery. Because particularly when you look at how consumer goods companies are seeing the economy, they see the inflation and the shrinking wallet of the consumer itself as a big threat to demand. So when you look at all these factors, I think the MPC has rightly changed the priorities and is now prioritizing inflation over growth, and saying that the inflation is now in intolerable zone, and some modest growth sacrifice is inevitable, but we have to bring inflation down because that is causing bigger problems for the economy.
Dr. Verma, it's a pleasure talking to you. Thank you for speaking to Business Standard.
क्या हाल?
मत पूछ यार,
फिर से स्टॉक्स में फंस गया। तो स्टॉक्स के साथ बॉन्ड्स, इंश्योरेंस, गोल्ड में बैलेंस कर।
इसमें बहुत तामझाम है।
तुझे 5 पैसा नहीं पता?
अब तो सबको पता है। 5 पैसा है ऑल इन वन अकाउंट। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है। Investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
The first half of the calendar year 2022, which draws to a close now, was marred by external headwinds like Russia-Ukraine war and US Fed's interest rate hike. The crude oil was on boil and inflation on fire, putting RBI, government and markets in a tight spot. We bring you a quick recap of what all kept traders and investors busy in the last 6 months and the sectors that should be on investors' radar going ahead. Indian markets are set to post their worst half-yearly performance in nearly 2 years, with the Sensex and the Nifty 50 slipping 9% each. The sentiment soured on account of an elongated geopolitical conflict between Russia and Ukraine, rise in key commodity prices, and central banks' actions to tame galloping inflation. The fall in mid and small cap indices was sharper, with both these indexes slipping 12% and 15% respectively on the BSE during this period. Analysts believe the second half of calendar year 2022 too will be marred by volatility.
Though commodity prices have started to correct, the second half of calendar 2022 will likely remain challenging for most economies and markets. Global growth may remain subdued and some economies may enter recession. This recession may be sharp and swift for a majority of countries, but the effects of that may linger on for a few quarters. These possibilities may get discounted soon and markets may fall more and make a bottom in the second half of 2022, post which a recovery can follow. Indian economy and equity markets may show higher resilience than most other markets in the second half of 2022. However, given the expected aversion to equities globally in view of rising rates and peaking of profitability, key thing to watch out for would be the FPI flows in India. If FPIs continue to be sellers in Indian markets, then despite the relative strong fundamentals of the economy, indices may remain under pressure.
A slowdown in corporate earnings is another headwind that the markets may have to face going ahead. According to analysts at Credit Suisse Wealth Management, amid high inflation and aggressive tightening by central banks, the downside risks to earnings growth are emerging. While we do not expect major earnings cut for Indian equities, some moderation in earnings growth cannot be ruled out, especially if global headwinds worsen further. That said, despite multiple headwinds, analysts suggest investors start nibbling into beaten down stocks and sectors selectively.
If FPIs continue to be sellers, their focus would be large caps, where their ownership levels are high and liquidity in the markets are also comfortable. These includes IT, financials, consumer staples, discretionary, auto, etc., which all these sectors could bear the brunt of FPI selling pressure. Traditional defensives may keep seeing buying on dips as they become more attractive. This includes IT, FMCG and pharma to an extent. New age internet companies and other high PE sectors could also remain under pressure. Cyclical stocks, including metals, auto and banks, could become attractive and may see bottom fishing.
On Thursday, markets are likely to remain volatile on the last day of futures and options expiry for the June series.
अब क्या किया?
शेयर्स में ट्रेडिंग।
तुम्हें 5 पैसा नहीं पता?
ओए, अब तो सबको पता है। 5 पैसा पर मिलते हैं रिसर्च टूल्स, पोर्टफोलियो एनालिटिक्स और इन्वेस्टमेंट आइडियाज भी। डाउनलोड 5 पैसा नाउ।
अब तो सबको पता है, investing made easy and rewarding with 5 paisa. Investments in securities market are subject to market risks. Read all the related documents carefully before investing.
All experts are united on one point, that the current volatile phase of the stock market will soon pass. Like the economy of any country, the markets too have different phases or cycles, and all investors should know about these patterns before making any move. Our next report offers some insight.
Just like stocks, markets too are cyclical in nature and go through various phases. Having an understanding of these phases facilitates trading behavior and helps one to be profitable in the long run. Broadly speaking, the market goes through 4 phases: accumulation, growth, distribution, and decline. Let's take a look at what happens during each of these phases. During the accumulation period, the stock price hovers around a certain range, depicting that the buyers are accumulating the stock. This phase starts after a stock has received major hammering or has seen a tremendous fall. Prices tend to consolidate or move sideways in the initial stage. Post that, there may be a new beginning for the stock. Thus, this particular phase can be seen as an early opportunity for investors who trade with long-term objectives. The next phase is the growth phase. During this phase, the stock or the index gives a breakout from the consolidation or accumulation phase and starts a fresh upward journey. As the price shows strength, market participation increases and the optimism too is at high level. Given the higher participation and the underlying bullish trend, the prices more often than not depict an unexpected sharp rise. Thereafter comes the distribution phase. Post stupendous gains in the growth phase, market participants get overexcited and build unreasonable expectations from the rally. The mood seems so buoyant that threats of real negatives are also overlooked. However, this is the stage wherein knowledgeable traders and investors sell their stocks, and you may see slow and steady selling or bouts of profit booking. Also, this stage may provide some early warning of a likely downturn. Finally, we enter the declining phase. In this phase, the stock price starts to witness massive selling pressure, with short sellers getting aggressively active. Thus, the declining phase is also termed as a bear market. Positive news or developments are easily overlooked during this phase as fear grips investors. Participants tend to liquidate their investments and holdings amid fears of further deterioration in stock prices. To conclude, having an understanding of these phases and awareness of the various market phases helps in managing the inherent risk. A systematic approach toward these phases helps one be profitable in the long run.
I'm backed by the nation's trusted bank, SBI, the banker to every Indian.
Billionaire investor Jim Coulter told CNBC on Tuesday that out of the 3 chapters in bear market, just the first one has got over. There are 2 more to go, so brace for it. Well, that's all we have for you today. We will be back with more news and analysis in our next episode. Stay tuned. Thank you for watching.
If you like this video, share it and subscribe to Business Standard. For more news, views, and insights, log on to www.business-standard.com. Do also follow us on YouTube, Twitter, Facebook, Instagram, Telegram, and LinkedIn.